Hi, it's Joni Michaels, and it's my pleasure to introduce you to Joe Clark, host of Consider This Program. Joe's a certified financial planner and former professor at Purdue University. He's the managing partner for the Financial Enhancement Group. Joe's passion is teaching people about their money so they don't make inefficient financial decisions that lead to frustration and devastation. The Financial Enhancement Group serves more than 900 families in 31 states and manages more than $400 million. The Financial Enhancement Group takes care of people who don't want to worry about their money so they don't make inefficient financial decisions. Joe addresses your questions about money and 5 critical elements of finance: retirement planning, or what we like to call your life after work, tax planning, investment planning, life happens, the good, the bad, and the ugly of life, and legacy planning. The Financial Enhancement Group can be reached at 800-928-4001 or visit yourlifeafterwork.com. The Financial Enhancement Group is an SEC-registered investment advisor. Securities offered through World Equity Group, Inc., member FINRA, SIPC.
Well, good morning and welcome to Consider This Program. I'm your host, Joe Clark.
I'm Ken Dilger.
And I'm Angie Kinzer.
And it is good to have everybody back in the house in the middle of quarantine. The state has opened up, at least with phase 1. We all have phases, I assume. We have 29 people at the Financial Enhancement Group. We are all working remotely, with the exception of radio days. So we're in the training center, which is, I have no idea how to figure square foot without a measuring thing, but it's a big room. We're all are 6 feet apart and all doing our thing. So you are listening to Consider This Program. Our job is to help you reduce financial regrets, to give you things you need to consider financially. And Angie, as always, is in charge of the program. So if you've got a question, something you want to put on the show, something you want to know about, or if you are ready for your next steps meeting, give Angie a call at 800-928-4001 or go to findyournextsteps.com. Angie.
I'm always looking for something interesting to kind of open up the show. And we've talked about this guy before, this Frank Abagnale. Do you remember the show Catch Me If You Can?
Yes.
Okay, so real life scam artist turned informant for the FBI, and he's been there with them for like 40 years as a consultant for fraud and cybersecurity. So every once in a while he'll come out and say what the biggest fraud issues are right now. And so he's come out to say there's a COVID-19 virus scam going around. And what it is these, I love this term, fraudsters. Will, it sounds so
Not
19,
gangsters, they're
no,
fraudsters,
the
Ken.
They will call, email, or text insisting that they need your address and personal information to get an additional stimulus check.
Do not give it.
No.
Do not give it.
And then the other thing that's happening is they're seeing a lot of calls asking for donations for cures or treatments. Now that they've come up with.
Yeah, stay away from those two guys. I mean, you know, in every bad crisis we've had, we find the biggest jerks we've ever seen. And, I mean, there's just no way around it. You can go back. They weren't as well known in World War II. We can go back and read about them now, about people who are trying to scam other people. Vietnam, you know, how to keep your son off the list, you know, those kind of things. And people would pay thousands of dollars, and it went to nothing, right? So just do not respond. I mean, that is as simple as I can say. And it's, you know, from a financial standpoint, it's why you need fiduciaries. You need people who don't get paid based on the decision that you make. You need people who are paid on providing the right advice. That's what we do. You don't need people that are selling you products. So give Angie a call, 800-928-4001. Thanks for that, Ange. We'll get right into the show.
Hi, Joni Michaels here. Joe's been hosting financial radio programs for over 20 years, and during his 7 years at Purdue, Joe developed the 5 critical elements. You see, there are 5 areas we all go through that can impact and even derail our retirement plans. YourLifeAfterWork.com has been focused on you on your retirement for over 20 years. You may have had a 401k as well as IRAs. Those are all defined contribution plans. Consider This program is about your defined contribution plans becoming defined distributions. You see, we all exit. You'll either take money out of those retirement plans when you decide or when the IRS decides, or your heirs will have to deal with the situation, but we all exit. I encourage you to call 800-928-4001 to meet with one of the talented financial advisors at the Financial Enhancement Group. I've listened to this show for years, and what Joe says just makes sense. Don't you think it's time for you to call 800-928-4001, yourlifeafterwork.com. Now let's get back to the show.
Well, good morning and welcome back to Consider This program. I'm your host, Joe Clark, along with Ken Dilker.
Good morning.
Angie Kinzer.
Hello.
Even in the world of quarantine, we're in a room big enough to be 6 feet apart. Life is good. Nobody's breathing on each other. We hope you are staying safe. Speaking of staying safe, there is this crazy thing called the market, your investments, the retirement, the 401ks. All of this is going crazy and wild. A lot of people are asking how a market can go down so far, so fast, and come up so quickly, so uncontrollable. And so I thought I would bring on, and I will openly admit this, in a normalized marketplace at the Financial Enhancement Group, we use three different ways of looking at the market. We look at it from the narrative, the standpoint of what we believe is going on in a long-term picture. We look at it from the fundamentals. That's Adam Harder, our Chief Investment Officer, our CFA. He looks at it from a valuation standpoint. And then online with us is Andrew Thrasher. He's a chartered market technician. His job is to look at it through the lens of what things are doing relative to one another, essentially how the market's moving. Forget what it is. What is the market moving like? How is it moving? And there is a lot of conversations right now over whether we're going to be in a V-shaped recovery or a W-shaped recovery. And I've had two questions from two different people over what is a short covering rally, because I mentioned that at one of our meetings. And anyhow, so I thought we'd just bring on Andrew and let him talk about that. So Andrew, let's start there. What is a short covering rally? What does that mean?
Sure. So there's different ways that you can make an investment. You can make an investment by going long a stock, meaning you buy it. Let's say you have an interest in owning Apple or Nike, and you think that they're going to be doing well in the future, so you buy their stock. You now are a very small owner of Apple or Nike. If you have an opposite view and you think that Apple's not going to sell a lot of iPhones, Nike's not going to sell a lot of basketball shoes, and you think their share price is going to go down, you can short those stocks. And so the way you do that is by borrowing those shares. So you'd go to your custodian, TD Ameritrade, Charles Schwab, Fidelity, whoever it may be, and you say, I want to short 100 shares of Nike. And they say, okay, we have some inventory of Nike to loan to you. And they take out a position where they're now long Nike, and then they let you short it through those shares. So when we see the market have such a strong correction, such a strong move lower, there's a lot of people that start shorting into that market, expecting that it would go down more. When we then have a bounce, we can start looking at the data and say, is this bounce, this move higher, based off people getting long, meaning they're buying shares, or is it because it's just those that were shorting, those that were bearish are now unwinding those positions? That person who shorted 100 shares of Nike, is he now taking off that short? But he's not necessarily getting long. It's not a positive, a bullish position to be able to get long Nike. He just no longer bearish on Nike. And so we want to evaluate the internals of the market and kind of see what was kind of the reasons or the catalysts that sent stocks in whatever direction they're going in. And that's something that I do every single day.
So the pleasure and points are reverse, right? Our pleasure, if you're long, if you have a 401k or an IRA, because you can't go short in those instruments, our pleasure is when the market is up. We're going, woohoo, retirement's closer, life is good. Our pain point is when the market is down. If you're short, it's the other way around. Now, on a side note, and then we'll get back to Andrew on this, back in 1998 was the first time you could make a stock trade below $30 a share that I remember. And the media called me and goes, how in the world can a company survive with stock trades at $30 a share? Because Ken, that used to be, before that it was $300, $400 to sell $10,000 worth of stock, right? That's why people came up with this quote unquote buy and hold theory, is because the cost of trading was so great. Well, today we have Schwab and we have TD Ameritrade and Fidelity and others that have zero cost of trading. So how do they make money? Well, they make money by charging you interest, Ken, when they loan my shares to you. Right?
Gotcha.
So when I have money at TD Ameritrade, it's called what we call it is in street name, right? So TD Ameritrade has custody of my shares of Apple. You want to short it. TD Ameritrade loans you my Apple shares. TD Ameritrade does not call me and go, Joe, is this okay? Right? And you can actually put on a brokerage account, believe it or not, and people do, you're not allowed to short my stock.
Interesting.
Very, very, very few people know that. I'm not sure I've ever filled one of those out for anybody coming into the Financial Enhancement Group, but it can be done. So, all right. So, Andrew, we've talked about what a short is. What does the covering really mean? What happens?
So covering is just undoing that short position. So when you go back to TD Ameritrade and you say, you know what, I've been short these 100 shares of Nike, and you undo that trade. So it's like you'd be buying a stock you would sell when you're short something, you then buy it back. And so then you're kind of giving those shares, essentially you're buying them back at whatever price it is from TD Ameritrade, or whoever your broker is. And that then by that you're now buying. So because you're buying, that's the same thing as if you were buying the shares straight out, and that can send the price higher if you're doing it enough. Doing it with 100 shares, probably not. Doing it with 1 million shares, maybe. So it just depends on kind of the size you're doing. But if you have enough of those people, enough price activity, it can then push those stocks higher. And so one of the things that we'll look at is how much of a stock is being shorted right now. How much of all the shares they have outstanding, let's say they have 10 million shares outstanding, and 30% of them are being held as short positions. Well, that's a lot of short interest. So if we start seeing those stocks go higher, we know that there's, like you said, you experience a lot of pain because that stock's going higher. When you're short, there could be a short squeeze as those people cover those positions, and that would then send the stock maybe even higher. And that's one strategy that some investors use when doing their research.
So when you say squeeze and short covering, I mean, those are words that you and I use on a daily basis. So let's just get there. So the squeeze is that pain point. The market is starting to go up, Angie, right? You shorted the stock at 50, it fell to 30. You thought you were in the money, right? You were talking about Jerry Maguire and show me the money and life was good. And then suddenly the stock's back to 60, and now you've got a 20% loss, right? Because you've borrowed at 50 and the stock's now at 60. You're being squeezed. And whenever you do anything on a short, you're doing it on margin. And, so you get the infamous margin call where you're being forced to liquidate positions and you have to choose them. So, Andrew, in the few moments we have left, are we in a period, based on your experience and what you do, are we in a period of a market recovery or a period of short squeezing? Where are we?
I personally don't look at it from the short squeezing viewpoint. Looking at it from historically, we've seen the market come down a lot, and then the market bounced a lot, and that's fairly normal. If you were to bounce a ball on the ground, the harder you throw it down, the harder it's going to bounce higher. And the market works in the same manner. That momentum that sent it lower will be reflective when it comes back up. And so we've seen that now as we have a big recovery. And so looking at different periods of market history, when we've seen these large declines, these bear markets, which is what I believe we're in, you can evaluate and see what is normal of a kind of a counter trend bounce, a dead cat bounce, a bear market bounce, however you want to categorize it, something that's just part of that overall down move where you're just seeing a little pop. Or is it the end? Are we at a January 2009, a December 2018, these moments where the market finally bottomed and started a new trend higher? And so that's what I do every day, is evaluating the market, seeing does this make sense to be a new bull market, or is this just a brief pause within a bear market? And so I think right now you could still make the argument either way. I think there's still some evidence left that we need to uncover to say that we're still probably within a bear market, but reevaluating that thesis every day as we get new data.
Hi, Joni Michaels here. We know you care about your money, but are you tired of worrying about it? The Financial Enhancement Group takes care of people just like you who don't want to worry about their money. As fiduciaries, the team at the Financial Enhancement Group will care for your nest egg just like they would care for their own if they were in your situation. There are many decisions you'll need to make as you face retirement, and the team at the Financial Enhancement Group is here to help you. Call 800-928-4001 or go to yourlifeafterwork.com to set up a time to meet. The confusion and complexity of retirement is almost as daunting as is the excitement of retirement. Don't let your fear and frustration of taxes and investing derail your retirement. Call the Financial Enhancement Group at 800-928-4001. They'll give you a complimentary second opinion on your strategy for retirement. Begin your adventure in your life after work. Call 800-928-4001 or yourlifeafterwork.com. Now back to Consider This program with Joe Clark.
Hey, a common question we get is, how much money do I need to be able to retire? You need to understand you're going to go through, or have already been through, 3 phases of finance: accumulation, preservation, and distribution. How much money can you take? How much do you need to have? I'm Joe Clark, the host of Consider This program.
I'm Ken Dilger.
And I'm Angie Kinzer.
So there is a rule that was put into place that we don't buy into, by the way.
Yeah, was it a real rule?
It came from a guy named Dr. David Blitzer. Blitzer is the one who picks what company goes in the S&P 500. So he's now controlled by Dow Jones. They actually bought that index, but it's his job. And he made a statement probably back in the early 90s. That's where the 4% rule came from. That if you put 100% of your money in the S&P 500 and you pulled out 4% a year, you would never run out. That is inaccurate. I do not believe in it, do not subscribe to that in any way, shape, or form. However, there is a percentage that we believe you can use, but it's based on the current valuation of the market. So Angie has got a bunch of questions, so I will shut up now and let her ask her questions and do my best to answer them.
Well, I mean, what are the latest calculations that we're hearing on this?
Depends. It really depends who you are. So in accumulation, Ken, what would you say that you believe your 2 biggest objectives are during accumulation?
To acquire as much wealth as you can.
To save as much money as you can.
Right.
So we always say saving the right percentage of income. But where would you save it? And I'm not talking about stock market now. Right, this is the thing that people forget about. It's from a tax standpoint. Right, so you're
Right.
you're
what, IRA or
you're looking at your kids, right? So he's got a junior in high school and he's got a daughter at IU, and what you should tell them at their age is they're trying to build tax diversification. So no different than you and I at our ages have stuff that's in stocks and bonds and cash. They need tax diversification, so money that is after tax, before tax, and already taxed, right? So you've got money that's Roth, you've got money that's tax deferred, and you've got money that is already after tax. You do not know what the IRS is going to do next, Angie, and so the job of any bright financial planner is to make sure that you've built tax diversification along the way, okay?
So this 4% rule, how does this impact those who are planning to retire this year? I know that they're saying the evaluation, was 4%. Now some people have guessed it at 2.3 or whatever these guesses.
You're seeing different numbers, and keep in mind, and I'm not trying to pick on you as a radio host especially. It's not an evaluation; it's a valuation. It's what do we think the underlying companies are worth.
Right.
So anytime you have a major correction, where things are overcooked, as we would say, overcooked, either the market went too high, right, or overcooked, they went too low. The valuation of the underlying companies change. And so when we looked at it in 2000. Go back to 1998. I told people they could take out 4% a year. Now, one, I was younger, hadn't built the company that we have today and the people that we take care of today, and I bought into the 4% rule. By February of 2000, I guess I should say, if I take that back, it was very, very clear to me that the market had overshot itself. Right? It was the valuation was not nearly matching the price that the market was offering, right? Y2K, the biggest non-event in history, happened, and nothing came from it, and people started putting money back into the market, and I told people that they could take out about 2.5% and be okay for a retirement period without a problem. Then March 10th, the tech wreck hit, and the market began to sink quickly, right? And so people who were taking out 4% weren't able to keep up. The distribution wasn't there. So if you go to that accumulation we talked about with Ken, right? That was saving the right percentage of your income and the tax diversification. In preservation, that's when you're adding money, but it's not as important as what you've already put in. Your nest egg is bigger than what you're adding. In that period of time, what really, really matters is the average return. But you have to have a discipline that lets you go through what we just saw. In distribution, it's the tax rate of each dollar you pull out and the amount of volatility between distribution points. Right? So the lower the amount of money that you pull out right now, the better off you're going to be. And so we talk to people about lines of credit, reverse mortgage, but we also always have 3 months worth of money in cash, and we just moved to 6 months worth of cash in people's accounts today on top of what we would normally hold as cash from a distribution standpoint, right? So that they're ready to go. So I don't know how to put that in football terms, Ken, but it's keeping some juice in the bottle.
Right,
just in
need more
case.
reserves, I
Right.
guess you call it.
Well, I
right?
think what the question meant is if people were planning to retire in 2020 and last year they thought they were doing great and saving and making all this money, and now all of a sudden this happens, should they still proceed with the retirement plans? Should they try to reconsider?
If they were set up correctly prior, yes. If they were set up correctly prior, that meant they already had money in cash reserves that was there that they were able to use. It's very easy to get diluted either by a market being down when it shouldn't be or a market being up when it shouldn't be, right? It's easy to get emotionally responsive to where the Dow is today or where the S&P 500 is today without looking at the underlying value. And that's really where Adam and Andrew come into play in our team and to look at what's going on. So I will tell you, I think right now, and this is Joe's personal opinion, it doesn't even match Adam and Andrew. Joe's personal opinion is that the market is happier than the economy is right now. So if I were retiring today, what would I do and how much do I think I could take? I would probably mark it down a little bit more from where we would normally go, and certainly not 4%. Because I think the economy has more struggles ahead of it. I would very much, and this for those of you that are buying annuities because you think that's a solution to the world, I would be very, very, very concerned about the inflationary pressures that have to come to fix this. One of the only ways to fix the problem we're in today is through inflationary pressure. That means inflation going up as opposed to inflation going down. And buying something that gives you a fixed income that is restricted as prices go higher destroys your purchasing power. That's another way of saying destroying your retirement.
You just brought up annuities, and we've seen that a lot of these employers are, because they don't know what else to say, so they're recommending that you buy one. What do we say to them?
Yeah, no. So here's the deal. Abdicating your responsibility as a parent, as an employer, as anything, is a mistake. And when we created defined contribution plans, we essentially abdicated the responsibility of professional money managers, Adam and Andrew and me, inside of defined benefit plans where you get a paycheck the rest of your life. We abdicated our responsibility to you. And because you don't know our jobs, you don't know what we do every day. You've been managing your money all the way along, and now all of a sudden you've got to figure out how to take money out. You've got to figure out how much money you can take out. When's the best time to take it? What's the best way to examine it, to manage it? I mean, it is, this is absolutely a mess, Angie, and that's why we invite people in for a Next Steps meeting. If you want to come in our 90-minute meeting, it's Next Steps. FindYourNextSteps.com. We'll give you things you need to consider today, things you're going to want to consider in the future, and if we choose to partner together, what FEG will do for you. We got to take a break. Angie's right. There's more questions. We'll get back after the break.
Hi, Joni Michaels here. Joe's been hosting financial radio programs for over 20 years, and during his 7 years at Purdue, Joe developed the 5 critical elements. You see, there are 5 areas we all go through that can impact and even derail our retirement plans. YourLifeAfterWork.com has been focused on you on your retirement for over 20 years. You may have had a 401k as well as IRAs. Those are all defined contribution plans. Consider this program is about your defined contribution plans becoming defined distributions. You see, we all exit. You'll either take money out of those retirement plans when you decide or when the IRS decides, or your heirs will have to deal with the situation, but we all exit. I encourage you to call 800-928-4001 to meet with one of the talented financial advisors at the Financial Enhancement Group. I've listened to this show for years, and what Joe says just makes sense. Don't you think it's time for you to call 800-928-4001, yourlifeafterwork.com. Now let's get back to the show.
Well, good morning and welcome back to Consider This Program. There is a lot going on. People are still living. I know. Surprise, surprise. Where's Gomer Pyle when you need him, right? We are still living. There are people that are still going to work, getting jobs, people that are still graduating from school, people that are still retiring. We started the last segment wondering and talking about what do you do when you go to retire in a confusing, that's probably the politest thing I can call, a confusing economy. I'm your host of Consider This Program, Joe Clark.
I'm Ken Dilger.
I'm Angie Kinzer.
So, Ken, let's just start with you before we go back to Angie's questions. What are you confused about right now?
Confused about, what happens when the economy opens up? How is this going to look as far as, is it going to be back 100% employment? Is it going to be, 75% of what it was before? What's the market going to do? How are they going to read what when things get back to somewhat normalcy? I think that's the biggest. I know we talked about the V-shaped curve coming up, the W-shaped curve. I think that's the biggest question that I have coming out, not now, but maybe 60, 90, 120 days out.
Fair. So I would answer that with what Adam calls labor friction. And the example that I used on the market carver last week, which is a free thing you can get if you go to yourlifeafterwork.com and sign up for our insights, you'll get my newspaper column every week. You'll get our market carver every week and anything else that we send out. It's a free thing that we send. Our job is to help reduce financial regret. So we teach people to the best of our ability. But the terminology labor friction, Ken, and when you talk about responding to normalcy, it ain't going to happen. And, what people look at the unemployment rate, which is probably closer to 18 to 20% right now than it is 13.
Right.
When they look at normalcy, you expect, Angie is my co-host of my radio show, a dear friend. She runs our events. Right, but she's also the one of the leads in the Vision Squad of helping us put our messages together. If I had to lay Angie off today, it does not mean that she could go be a contractor tomorrow working at one of the local construction companies. Right, it doesn't mean that she could go be an IT consultant for the people who run our computers. Right. So when we look at the unemployment rate, part of labor friction is we presume if a body is let go of one job that they can go to another job. And that's not the way that it works. I mean, most of us have specialized training and education. And when you look at Europe, for instance, we have about 2.4 million farms in the United States. The Euro region has 10.4 million. And now I know what you're thinking. You're going, wait, the United States is the breadbasket of the world. Of course it is. The difference is the farms in the European Union have 40 acres. Our average farm is 475 acres, right? So we have big John Deere tractors. We've got specialized equipment, right? It doesn't mean that in Ireland I can take somebody who's used to being in cybersecurity who just got laid off and put them on a farm, right? They don't have the training yet. And that's where labor friction really comes into play.
You mentioned in the last segment that, if you're planning properly, then you really shouldn't find yourself underfunded. But let's say you do. And we've had some specific questions like, is working longer the answer? Is borrowing from my portfolio the answer? And then we've had real specific questions like, what's changed with borrowing from your 401k or your life insurance policy? What are the options?
Fair. So the Secure Act came out December 20th of last year, before all this stuff happened. The CARES Act hit March, I think it was 27th, after the COVID virus came into play. So a lot of changes have actually occurred. Today, you can borrow money out of your 401k up to $100,000 that you're vested in. Before it was $50,000. You can withdraw that same amount of money out of your 401k and pay the taxes back over 3 years if you've been affected. So you've got to be careful. You've got to be able to show that you were impacted by COVID. This is just not a carte blanche, be able to go out and get the money. And
who do you show it to? Your own
it's
HR department?
The third-party administrator is the one. So the one who signs off on that. So when you hear me talk about these things, I will openly fess up to you that I do every one of these things that I'm talking about, from the PP loan to everything else, because I want to see how it works. I have multiple accounts at TD Ameritrade. Some of them are sent to me by email. Some of them are respond to me via physical mail, because I want to see what it is you're getting. It's just my nature. I want to know what the forward-facing thing is, and to try to figure out ways that we can make improvements in the communication, whether they come from TD Ameritrade or Charles Schwab, or from Joe Clark from the Financial Enhancement Group. So there's a lot of different things to look at here. What you have to have is an accurate plan that is not based on reacting to the emotional pressures of the time, but rather a response plan that says, hey, here's where we are, here's what's going on. So I can't tell you on this radio show whether you should use a home equity line of credit, a reverse mortgage, a margin account, cash from another scenario. I can't tell you that without looking at your personal situation. What you don't want to do ever is be forced to sell stock when you don't want to sell stocks.
Especially if it's at a loss.
It doesn't matter if it's a loss or a gain, right? So our basis in Apple, we bought Apple in 2006, Angie. Our basis in Apple is $9 a share. Apple is at $290 a share today, right? But it was at more than $330, right? So Apple for Ken could very well be at a loss. It's $40 a share lower than where it was at the top, and for me, it's a huge gain. Whether it's at a loss or at a gain only matters from a tax standpoint. You cannot ever let your emotions get into that.
Well, I think the question was about if you found yourself underfunded because of what happened here just recently.
But the share, I'm telling you, the share price and whether it's a gain or a loss should be immaterial in that decision, other than from a tax standpoint.
Okay. The other question someone had as an option, if they were getting ready to retire, found themselves underfunded, should they claim Social Security early when they were already planning to put it off as long as possible?
Not unless you have to. I mean, that is a reserve element of being able to bring in money. I get it. I understand why that is a natural thing to do it. I had one of my quote-unquote pen pals from prison, somebody that was in elementary school with me that spent the last 30 years in prison, read the article that said Social Security is going to be defunct by the time it's 2035. He says, is it even going to be there for me? It's like, well, you've been in prison, so it's not going to be the benefit that you want it to be. But the reality is, if the funding is done, we go to 75% benefit, not a 0% benefit, right? Turning on Social Security early is not what you want to do if you have other options. But again, this is why you need to call Angie, 800-928-4001, and say, hey, I'm ready for my next steps meeting. We're running these things every day over Zoom. We're a couple weeks away from being able to have them live in the office. But the next steps meeting is a 90-minute meeting with one of our financial planners. We're going to give you things you need to consider today, things you're going to want to consider in the future, and if we choose to partner together, things that FEG will do for you. So give Angie a call, 800-928-4001, and go to findyournextsteps.com.
Hi, Joni Michaels here. We know you care about your money, but are you tired of worrying about it? The Financial Enhancement Group takes care of people just like you who don't want to worry about their money. As fiduciaries, the team at the Financial Enhancement Group will care for your nest egg just like they would care for their own. If they were in your situation, there are many decisions you'll need to make as you face retirement, and the team at the Financial Enhancement Group is here to help you. Call 800-928-4001 or go to yourlifeafterwork.com to set up a time to meet. The confusion and complexity of retirement is almost as daunting as is the excitement of retirement. Don't let your fear and frustration of taxes and investing derail your retirement. Call the Financial Enhancement Group at 800-928-4001. They'll give you a complimentary second opinion on your strategy for retirement. Begin your adventure in your life after work. Call 800-928-4001 or yourlifeafterwork.com. Now back to Consider This program with Joe Clark.
You know, it's a crazy world you live in when things can move at the speed of sound. And I'm not talking about 5 miles an hour or 10 miles an hour. I'm talking about things that are moving at 100 miles an hour. So December 20th, the Secure Act was passed. It made some changes to required minimum distributions, to the stretch IRA, to 401k plans. And then all of a sudden we had this silly virus that kicked in. And when I say silly, I don't want to belittle that. I mean, this is majorly impacting people that we know and some of you that are listening to it. But we had to pass the thing called the CARES Act. And the confusion, what's a Secure Act and what's a CARES Act and what do they mean are really, really messing with people. And the older you get, I mean, folks, I hate to say it, but the older you get, the easier it is to be confused. And we had one of the largest accounting firms in the state of Indiana actually confuse the CARES Act and the Secure Act in slides that they made in a presentation to a very, very large group of people in Indianapolis. And, so this can happen to the best of us. So please be careful with the research that you're talking to. So Angie's going to ask me some questions. We're going to break down the Secure Act, the CARES Act, what it really, really means for you if you're in a period of time that's called required minimum distributions. You're listening to Consider This program. I'm your host, Joe Clark.
I'm Ken Dilger.
And I'm Angie Kinzer.
So Ken, what's a required minimum distribution?
It is the age that you have to take money out of your 401k or an investment account.
Not an investment account.
Or IRA, I guess you call it.
Right. IRA, 401k, 403b. Tax-deferred account would be the verbiage of choice. So what does, Angie, when we talk about required, what does that mean?
That means that the IRS wants their money. You've reached the age and they've deferred your taxes long enough that it's time to pay the piper.
So I tell people that you started off with a defined contribution plan, 1980. Ken and I were kids. Angie was a kid too.
Okay.
We're all kids. 1980. They changed the rules. They started to get rid of defined benefit plans. Defined benefit is when you get a monthly check that was coming out that somebody like Adam and Andrew and I would manage. And the market still went up and down. You guys just didn't know it because you didn't have online access to brokerage accounts. You only get a statement once a quarter, once a year for a retirement plan, right? And people like Adam and Andrew and I did all the suffering emotionally of markets going up and down. Markets were still volatile in the 70s. 70s were a horrible period of time. And in 1980, they changed it to defined contribution plans. Defined contribution is now Ken has a 401k, Angie has a 401k, Joe has a 401k, right? I put money into it every quarter. Actually, I put money into it more often than that. But Angie has money that goes in, Ken has money that goes in. But they are their own fiduciaries, right? Now, in Angie's case, she selected us as the fiduciary. So, Adam and Andrew and I make the elections inside of her 401k. Ken's doing it on his own. He's got a 401k. He's got options. He's a smart guy. He's a college grad from Illinois, right? And has done well. And, but he's doing it on his own. He's figuring out. In his 401k, they got a list of choices. He's figuring out where to put the money. Right? The same choices that in 1980 would require a CFA, an Adam, and an Andrew, and a Joe to be able to make those decisions. We have deluded people into believing they can make those decisions on their own. And when you're in the preservation phase, and the market just rises higher, it's hard to dispute that. I mean, why do you need to pay Joe or the Financial Enhancement Group when a market is just rising. You know, I get calls from my friends that go, you must be just freaked out over all the hand-holding and all the stuff that you have to do with your families. And if we've had 10 calls since the beginning of the virus, I would be shocked. Now, we got 29 people on our team. There could have been calls. You know, I guarantee you I have not taken more than 5 of them because we communicate every week with the Market Carver, which you can get for free. Just go to our website at yourlifeafterwork.com. You know, people they know we have a strategy, a plan in place in terms of where we are. All right, Angie, I know I'm off track.
You are off track. We said we were going to talk about the Secure Act versus the CARE Act in regards to your RMD.
All right.
So we know that the Secure Act came first, and we know that back at that time you had to be 70 and a half. What has changed now?
So in the Secure Act, this is before the virus ever came in.
Yes.
Your RMD had to start technically in the year after the year you turned 70 and a half. That meant that if you started at the year you were 71, you actually had to make 2 distributions, the first before April 1st. And if you think you're confused, so were the CPAs. They realized this is probably a bad plan. So now, instead of that rule, you no longer have to take required minimum distributions if you're 70 and a half. You have to take them starting at age 72.
What if you turned 70 and a half prior to January?
You still have to take them, period, right? That's the Secure Act. Now we move to the CARES Act. That's the one that was created by the stimulus. That was the one that was created this year in 2020. No RMDs are required this year. So it doesn't matter if you're 75, 85, 70 and a half. You do not have to take a required minimum distribution this year. You can still take it. And what we've been able to sit down with people is say, hey, you know, you may have not planned on taking, I mean, you don't have to take it this year, but that doesn't mean you shouldn't take it this year, right? And that's where you get into that tax planning strategy.
What if you have an automatic withdrawal that
You can
just
stop
occurs? Okay.
You can put back money that you've got in the last 60 days and say, changed my mind, want to put it back in. But before that, you can't. So, you know, we have people who take out RMDs in January, and the rule came out March 27th. That was more than 60 days. They can't put it back in, right? Part of, the Boy Scout, always be prepared motto did not help. We did not know that this rule was going to kick in place. But again, many of the people, especially the way we have our financial planning set up, many of the people who got the RMDs should have taken them anyhow. Do not let a rule that has been put into place excite you into doing something that you shouldn't do. If you do not start all financial planning conversations with having your 1040 in front of you, you are making a mistake. So when you hear me talk about the fiduciary focus, right, you're paying attention to risk and volatility, fees and expenses, taxes today and tomorrow, and real return, which means inflation and purchasing power. All 4 of those have to be the equally dominant thoughts in all decision making.
Did anything change with the beneficiaries of inherited IRAs?
The stretch is gone. Now, interestingly enough, Ken, you could read the entire tax code, which I know you won't. You could read the entire
Probably not.
You could read the entire tax code. You will not find the word stretch. It's not in there. But what a stretch meant is if something happened to Ken, his 2 kids would be able to take money out over their lifetime out of his pension plan or his 401k that he's got with the NFL. If you were over 70 and a half when you kicked the bucket, they would have to take it out over your life expectancy. Now that rule has changed. If somebody is over 70 and a half and they did not die before December 31st of 2019, that you have to empty the money out as a beneficiary in 10 years, unless you're a spouse. If you're an inherited IRA, you have 10 years to eliminate the bucket. Hey, you're listening to Consider This program, 800-928-4001. We'll take a break and be right back.
Hi, Joni Michaels here. Joe's been hosting financial radio programs for over 20 years, and during his 7 years at Purdue, Joe developed the 5 critical elements. You see, there are 5 areas we all go through that can impact and even derail our retirement plans. YourLifeAfterWork.com has been focused on you on your retirement for over 20 years. You may have had a 401k as well as IRAs. Those are all defined contribution plans. Consider this program is about your defined contribution plans becoming defined distributions. You see, we all exit. You'll either take money out of those retirement plans when you decide or when the IRS decides, or your heirs will have to deal with the situation, but we all exit. I encourage you to call 800-928-4001 to meet with one of the talented financial advisors at the Financial Enhancement Group. I've listened to this show for years, and what Joe says just makes sense. Don't you think it's time for you to call 800-928-4001, YourLifeAfterWork.com. Now let's get back to the show.
Well, good morning and welcome back to Consider This Program. I'm your host, Joe Clark.
I'm Ken Dilger.
And I'm Angie Kinzer.
Here's the deal, folks. People have in their lives major decisions that they have to make. And you would like to think that you could have a good period of time to be able to study, research, and do all that. Many of these challenges or decisions have deadlines. For those of you at Allison, we take care of several of you. But for those of you that are at Allison Transmission in Indianapolis that have been around for longer than a few years and are over 60, you have a decision with a deadline of May 18th. We've put together a checklist for you that gives you 7 of the 23 things that we would consider in a planning meeting. You can get that checklist for free if you got somebody who works at Allison. You may want to reach out to Angie at 800-928-4001. We're happy to send it. But
you can also get it from our website.
Yep, and
YourLifeAfterWork.com.
Happy to share that with you. So I'm gonna hit these 7 things. Angie's gonna say, why are these 7 things on the checklist, and I'm gonna tell you why they matter.
Okay, so let's say you refuse the offer, and what if there's a possibility you might get laid off or even let go if you didn't take the offer?
So what is the strength of your position, Ken? Right? You've got to always ask that. What is the viability of this company being able to stay in play? I don't think Allison is in long-term risk. I will tell you, manufacturing is an endangered species. Not all companies, but some companies. The slow boat to China is an old expression of us shipping stuff over. And the reverse is true. We have a lot of manufacturing today that still exists because boats were already in the water when the virus hit, right? You're going to see the slowdown in manufacturing actually start to happen in another 2 to 4 weeks.
Why would your health matter in making this kind of decision?
It's a life expectancy decision. So you've got an opportunity to take a pension, a defined benefit, where they're going to pay you X amount of dollars per month as long as you live. If you know that you have a huge health issue, or a health crisis, or if you know you've got a major beneficiary inheritance that's coming, what you do might be a little bit different in terms of your decision-making process.
What about, does it matter, let's say you accept the buyout, and you say, does it matter if you're going to plan to work somewhere else?
It does from a tax standpoint. It does not from Allison's standpoint. And one of the things you people need to consider, and I remember this very conversation, Ken, with one of the families we take care of. That it was 1997. He said, "Joe, I love my job. They pay me $70,000 a year at General Motors. Why in the world would I ever quit?" And engineers are not prone to make decisions in minutes. And he did, because I looked at him and I said, they're not paying you $70,000 to work because they'll pay you $40,000 to go home, right? They're paying you $30,000 as an engineer with 33 years on the job. And so he retired the next morning, and about 6 months later, which happens all of the time, they hired him back as a consultant. And so some of us would call that quote-unquote double dipping, but that's what's going to happen. I mean, a lot of you are looking at this through a lens of only the lens that they're showing you. J. Edgar Hoover created the FBI. You had to be, if you're 55, you had to retire. Think about how old that was when that happened. We're getting ready to lose a lot of the top FBI minds in the country because of the baby boom. There will be adjustments, but right now, all of the FBI agents that we take care of are looking at it through the lens of, at 55, I have to retire.
And we've helped a lot of families who have had this very same decision with their company. And I remember you always saying in those workshops that we did, this is not a cookie cutter decision. I mean, it's very.
No. There are 23 that I take through and grade either plus or minus on each of the 23 things that I think about. You add them up, and then you make the best decision possible. There's no way to get this perfect, right? I've seen people who you would think are going to drop dead if they had to walk to their car in the parking lot, who are alive at 95,
Yeah.
right? I've seen, I've also had marathon runners drop dead of a heart attack. So you use the most probable as opposed to the improbable statistics when you're looking at this. But health is clearly a matter.
So is it probably a good idea to rework up a budget when you're trying to make this decision?
You have to know, never take any more risks than you have to take to be able to get the job done. Right? That's one. And so you have to know what your retirement budget is going into retirement. And a retirement budget is what it takes to maintain your standard of living, both in fixed expenses, the things you have to pay for, and social expenses, the things you want to do, the travel to Disney, etc. Social expenditures, in my opinion, do not need to be inflated over a lifetime. Fixed expenditures, you're messing with your future if you don't take inflation into consideration with fixed expenses like property taxes, utilities. I opened up my buddy's property taxes last night or on Sunday night at his house when we were socially distancing on his back patio. And she goes, why are you I manage their money, but she goes, why are you opening the property tax thing? And I said, well, my property taxes went up. I want to see what yours went up, right? And oddly enough, it was exact same percentage. That's inflation, right? That stuff is going to continue to come. And we can go and we can fight the courthouse and say bogus, blah, 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 blah. But the reality is we're going to lose. But it was a 2.5% increase. If you do not look at what's going on, inflation will destroy you.
So should it be important to really go through that offer and find out what's included, or especially insurance?
Oh, yeah, but we've gone through that offer a bunch. So the insurance, the way that it is going to be very, very different depending on your age when you accept this buyout. If you're 62 versus 67, we had somebody who retired from Allison 2 years ago that was 70, right? It really, really does depend on your age in terms of where that is. But to leave health insurance out of your thought process or your equation is a real big mistake.
And I guess, lastly, not even lastly, these are just a couple of the different things, but how well do you love your job?
Yeah. If you love it and you don't mind working for less than what they'll give you, but you have to look at it that way, right? If somebody paid me $50,000 a year to do my job and they'll pay me $30,000 to leave, can I go somewhere else and have more fun for $20,000? Right? Now, anybody who knows me knows I will not leave. I will not give up this microphone. I will not give up my whiteboard. I would do this for free, except I get paid to do it. I love to teach people about money, but that has to be part of the equation. How emotionally sound are you in terms of what you're doing? And can you be emotionally sound somewhere else? Or, are you ready to go home and watch Gilligan's Island? You've got to pick that. But give Angie a call at 800-928-4001. Go to yourlifeafterwork.com. Get the checklist. If you know anybody who's working at Allison, please share their name with us so that we can reach out to them and try to give them security and comfort and knowledge in this period of time. 800-928-4001. We'll take a break and be right back.
Hi, Joni Michaels here. We know you care about your money, but are you tired of worrying about it? The Financial Enhancement Group takes care of people just like you who don't want to worry about their money. As fiduciaries, the team at the Financial Enhancement Group will care for your nest egg just like they would care for their own if they were in your situation. There are many decisions you'll need to make as you face retirement, and the team at the Financial Enhancement Group is here to help you. Call 800-928-4001 or go to yourlifeafterwork.com to set up a time to meet. The confusion and complexity of retirement is almost as daunting as is the excitement of retirement. Don't let your fear and frustration of taxes and investing derail your retirement. Call the Financial Enhancement Group at 800-928-4001. They'll give you a complimentary second opinion on your strategy for retirement. Begin your adventure in your life after work. Call 800-928-4001 or yourlifeafterwork.com. Now back to Consider This Program with Joe Clark.
Well, good morning and welcome back to Consider This Program. I'm your host, Joe Clark.
I'm Ken Dilger.
And I'm Angie Kinzer.
All right, Ange. So we've talked about a lot of things today, and
Yes.
and you've been able to run the show and kind of control what's going on, and you get to do that, and I'm happy for you. It's Cinco de Mayo, by the way, when we're doing this. So I have my cocktail of Perrier water. It's easier on my belly. I like to drink it. You know, it's been an interesting year. One, I'm shocked that it's May 5th. It just seems to, as miserable as I am of having to socially distance myself, you know, I've not hugged anybody but my wife. That includes my kids, which is just driving me insane.
Yeah, that's hard.
You know, seeing my best friend and his wife on Sunday and not hugging them.
There's been some real interesting things come up too since we've been stuck at home. And one of the things that I found a list on were the top 5 challenges that you're seeing like on Instagram, TikTok, and all that. Like they have a challenge going on Instagram right now called Until Tomorrow. And you have to leave it up for 24 hours. And the only thing you can say about your post is if you can only post it and it's the most embarrassing picture you can find of yourself. And if anyone likes it, then you have to send them a message and they have to do the same thing. And then, you know, of course, there's ones on TikTok. There's the virtual
Ain't gonna
bingo.
happen. I am not participating. I didn't even know until this morning when I was reading a report. And I'm only 53, guys. So, you know, one, I listen to no news. I read no newspapers. You need to know that. I read all blogs and I read books. I do not listen to Fox News, nor do I listen to CNN News. When CNBC is on, which is on pretty much 24 hours a day in my house, I mute it. And if it's a money manager that's on that I like, I listen to it. I don't listen to any of the commentators. I refuse, right? So I will not let somebody emotionally control my life in terms of what it is. And so I have no flippin' idea what TikTok is. I read about it yesterday for the first time.
It's like lip syncing to a song or doing a funny sketch or something like that. It's all for fun and games, but we're kind of taking challenges a little more seriously.
Absolutely. I just finished a 30-day, Ken, you'll be excited, 30 days in a row of yoga, an hour a day.
Nice.
And my trainer informed me on day 20 that the 30th day would be 90 minutes, and she wasn't kidding. And now I talk to other yoga instructors, and I found out she had snuck in Pilates into yoga.
Oh.
I would not have intentionally signed up for Pilates, but that's a lot of core strength. My stomach hurts in ways that it hasn't hurt since I played football, you know, and wrestling. I think I probably did more core work in wrestling. So we did that. But tell me about our other challenge.
Here at FEG, we're going to do some educational challenges through our Facebook page. So stay tuned for that.
6-day challenge on Get Smart. Do you remember Get Smart, Ken?
Of course.
With
Maxwell.
Yeah.
In his shoe phone.
Get smart about your retirement. I'm going to spend 30 minutes of my life here teaching you live every night. It's going to start in a couple Thursdays. Get signed up for it at findyournextsteps.com and go to yourlifeafterwork.com. Get with Angie at 800-928-4001. Let's spend 6 days together and get smart about your retirement. Have a great week, my friends. Thank you for being here.
You've been listening to Consider This Program with Joe Clark. As a certified financial planner, former professor at Purdue University, and with 31 years of experience helping families just like you eliminate the fear and confusion of retirement, Joe's team has the answers to your questions. Go to yourlifeafterwork.com or call 800-928-4001 and find a time to meet with the Financial Enhancement Group. There's nothing that will separate you from your retirement as fast as the IRS. There are many questions that can be answered at the Financial Enhancement Group. Questions questions like when to take Social Security, how will my 401k be taxed? These questions are just the tip of the iceberg, and you need to be asking these questions now before it's too late. The Financial Enhancement Group has offices in Anderson, Fishers, and Lafayette, Indiana, but they also take care of families in 30 other states. You care about your retirement, you don't want to worry about your money? Then the Financial Enhancement Group is right for you. As fiduciaries, they are required by law to treat your money as if it were their own and they were in the same situation. Call 800